about ESG investing challenges and personal values conflicts. And now I'll turn it over to Igor Zuckerman, the CEO and Chief Investment Officer of Eureka Wealth Solutions.
Thank you, Julia. And welcome everybody who was able to make it. I just wanted to make sure you know that we are recording this, so the recording will be available if anybody wants to go back to it, or anybody who wasn't able to make it and can view it later. With that, let me talk about the agenda for today. So first I'll have to do a little bit of housekeeping, and then we'll dive right in. We'll talk about impact investing, the definition first of all. We'll talk about ESG and SRI, what those are. We'll touch briefly on thematic investing. We'll talk about ESG data, and then we'll finally get to the meat of today's specific discussion, ESG values and conflicts. We'll specifically look at also the Russian invasion of Ukraine and through the prism of ESG questions that it raises. And then we'll do a couple of case studies. One is going to be on fighting climate change, and another one will dive into the largest ESG ETF. And then we'll get to the conclusion, and we'll leave a little bit of time for Q&A. So with that, the housekeeping items are unfortunately the disclaimers that we have to make. This is something that our compliance is going to be very unhappy about if we don't say. There is the last page of the presentation will have all the disclaimers written down, but basically the most important things you need to know is that we are not here to sell or solicit buying or selling any specific securities or investment products. This entire presentation is for informational purposes only. Obviously, we may have positions, or our clients rather may have positions in some of the investment vehicles that we mentioned. Again, we're not trying to solicit buying or selling those. And obviously, any performance that we're talking about, as any advisor will tell you and any prospectus will tell you, past performance does not guarantee future results. And also, if we mention any specific names of products or indices, their trend marks are of their respective owners. And that's the nature of the disclaimers we have to make. Also, on housekeeping, there will be, this is meant to be interactive, although I understand that it's a little more difficult since it's not in person, but feel free to utilize the chat function and type stuff in, especially if I'm asking questions. Also, if you do have questions for Q&A, feel free to type them into the Q&A. This is going to be, I'll probably take them at the end of the hour. But if anything comes up during the presentation that I feel like is relevant to what I'm talking about, I'll try to answer right there. And if not, feel free, if I don't get to your question for some reason, feel free to email me later. There will be email will be provided, and I'll try to get to all of those after the presentation. All right, so without further ado, let's dive in. We actually have a lot to cover, so let's talk about impact investing. Some of the recent headlines that you see here. Obviously, impact investing and its various forms have been around the headlines for the past couple of years quite a bit. I suspect that's one of the reasons people are interested in, people hopefully coming to webinars like this. Why is that? Impact investing is not new. It's been around. The actual term and some of the methodology has been around for almost 30 years now. But over the past decade, and especially the last 3 or 4 years, there's been a lot of drivers that is driving the impact investing. And the first one obviously is the investor demand. People, especially younger generation, demand to know where the money goes and demand to have a say in where the investing dollars are going. Financial returns have improved. We'll talk a little bit about that going forward. So just to give you an example, investing in early solar stocks, maybe in mid 2000s, in the first decade of the century, has been a miserable experience. If you haven't experienced it, you can take my word for it. Most of those companies have lost a lot of money. In fact, pretty much all of them have gone bankrupt. It's obviously a very different investing environment these days. So that's a major factor. Data availability, again, this was hard to come by. We'll talk a lot more about data going forward and different types of it and different issues, but at least the data is available today. Of course, there's new technology to research and to invest in impact, and of course, supply of investment solutions such as funds, whether it's mutual funds or exchange traded funds or various other vehicles that we'll talk about later. The availability of those has exploded, and that's kind of a self-fulfilling prophecy. It helps drive the investing, but also they only appear once there is enough demand. And as you can see from the chart below, this is one of the surveys that shows by generation that the younger generation is driving the demand. So what's impact investing? I think most people who probably come to these webinars, or people who have been around investing, have a general intuitive idea what it is, but I wonder if anybody has actually looked this up. This is what comes from what I would say three authoritative sources. Wikipedia, which is the knowledge of all things, and Investopedia, specific knowledge to investments, and World Economic Forum, which is an authority in the world economy. And if you look at those definitions, they're all pretty vague to me. There is no specifics. The only thing that you can get from all of them, and they're, like I said, all kind of similar, is that there should be a specific benefit towards social or environmental effects, and there should be a financial gain associated with it. We'll mention that a few more times, I'm sure, throughout today. We're talking about investments as opposed to, let's say, charity, where the only reason you would do that is to do good, and you're not concerned with the financial gain. If we're talking about investing, financial return or financial gain is part of the equation. But other than that, these definitions are pretty vague. It leaves a lot to, let's say, an interpretation. So some of the more common types of impact investing, we'll talk about this right now. The media is talking about all of them a lot of the times interchangeably, and it creates a lot of confusion for potentially a lot of people. What is impact investing? What is ESG, SRI, and there are some other abbreviations out there that could potentially be very confusing to people. So SRI is the socially responsible investing. So the idea is to integrate some of these factors into the investment analysis and avoid investing in something that could potentially have negative impact on, let's say, the environment and the society. Some of the terms like values-based and ethical investing, those are pretty interchangeable with SRI. The one point to make here is that to achieve the socially responsible investing strategy, what investors and asset managers would do is use what's known as negative screen, which basically excludes things you don't want in your portfolio, which sounds intuitive, but we'll talk about it literally in a minute. Let me move on from that to ESG. So ESG literally stands for the three main principles: environmental, social, and governance. And all it is, the definition of it is that it's a set of standards that a company would use in its operations, that investors, if they're socially conscious, would use to screen for potential investments. If this sounds similar to SRI, it definitely is similar, but there's one major difference, and that's in how the portfolios are constructed, and that is by using a positive screen, which is essentially determining what you would like in your portfolio, what you would like to be the inclusion criteria, and use that to select your investments. One of the things also that we'll mention again is that a lot of the ESG strategies use proprietary ESG scores, which is based on data, and that's and we'll talk about that in a second. So just to give you a sort of examples of what some of these ESG criteria look like. This is a graph from the US SIFI, which is the Forum for Sustainable and Responsible Investing. And the way that they break it down is like this. To be honest, the environmental part is usually fairly easy to understand and to explain. The social and corporate governance, some of the things that a lot of investors may not be as familiar with, and frankly are not being mentioned as much in the media, but these are some of the things that some of the criteria that, again, investors and asset managers will look at in each one of these three spectrums. So let me go back for a second to the negative and positive screening. This is a better explanation. So negative, basically what you start is with an investment universe. So you start with your sort of set of potential investments, and then you determine what you don't want in it, the negative criteria, and you start taking things out. So for example, in this particular ETF, by the way, I will use this blue script for ETF so you can easily see the tickers. Again, this is not a recommendation of any kind. This is just for your information. And so this is being used as one of the examples. This is a Wisdom Tree China X State-Owned Enterprises Fund. So it starts with a Chinese index of Chinese large and mid-cap companies and takes out everything that I believe has at least 20% ownership by the state. And that is a form of ESG. It's actually governance and potentially social effect. And that will allow you to take things out of your portfolio. Here's another example, which is the fossil fuel free ETF. It basically starts off with a US large cap index and then strips out everything that's fossil fuel. And this is what negative screen looks like. On the other hand, the positive screen, you start with nothing. You say, okay, here is my universe, potentially the same universe, let's say S&P 500, or it could be any other initial set, but you don't add anything unless you determine that it actually belongs in your portfolio, rather than taking it off from the existing portfolio. So you would select the positive criteria, which sometimes or usually is a theme, and we'll talk about that in a second. And then you only leave the things in your portfolio that you want in it. So here's an example. This has been a very popular ETF in the last couple of years, Global Clean Energy ETF. And the criteria for it is literally picking the companies that fit that theme. So the methodology is a little more involved, but basically, intuitively, you hopefully understand that this is what they're doing. Here's another example, the Spider Gender Diversity Index ETF. So again, it's built from the ground up only the companies that pass a certain a certain threshold of being gender diversity within companies, and only those companies make the cut. Everything else is not in it. So hopefully that gives you a better picture of how this screening works, and one of the major differences between SRI and ESG. If you have any questions, feel free to type them in. I'm or in chat or in Q&A, and I'll take them at the end of the session. Let's talk a little bit about themes, since we touched on this. I know I'm covering a lot, so I'm trying to take a pause and see if anybody has any questions, or if you're still with me. All right. So what's a theme? Themes have been made very popular in the last few years. If you follow companies like ARK Invest, led by Kathy Wood, they've exploded in popularity, but in reality, there's literally hundreds of them these days. And a lot of these themes are considered to be basically innovation and disruption types of themes. And that's definitely a big portion of it, but that's not the only thing. The broader definition of a theme is that it's a trend that includes potentially economic, demographic, geopolitical, regulatory, and technology factors. So it's a combination of different things. And the themes, that is, could potentially generate beneficial investment opportunities. Obviously not all of them, depending on many specifics, but a lot of them could. If you're able to recognize this trend early enough and then identify the correct investment opportunities that have the best opportunity to take advantage of that theme, you could see significant market outperformance. This has been actually a staple in traditional institutional portfolios for many, many years. It used to be very, very expensive, only available to institutional clients or very, very high net worth individuals. But it's now a lot more available to the masses. These are some of the theme examples. So just to give you a quick sort of idea, in terms of technology, in terms of disruption, if you would invest in early PC makers and all the PC sort of ecosystem back in the 80s, companies like Microsoft and Intel, or in the 90s in the early internet companies, such as eBay and Yahoo and Match.com and eventually Google and Facebook. Well, if you did, you'd probably be not attending this webinar. First of all, you'd probably have done very well. But these were the types of dominating themes back then. And the idea is that even if you didn't invest in just one company, if you invested in 20 companies that would be beneficial, would be beneficiaries of those themes, and 15 of them went under or got bought out, and a couple did okay, and 2 or 3 became the Microsoft and the Amazon of the world, you would still be very, very far ahead. So this is kind of the idea behind themes, and you can see a lot of these themes, and I put together some ETFs that are beneficiaries of those themes, so you get an idea. But again, it's not just technology, it's geopolitics. So some of the things like rise of China and the BRICS, infrastructure that's been in the news a lot lately, things like the increase of data flow, which could be considered technological as well, but it's also driving a lot of the economy. and others. So just a few names in SRI and ESG, but we also have social trends, eating trends, food trends, fitness trends, pets, cannabis, social justice, and many other social trends that are not even included in here. A lot of those are not necessarily in the media front and center, but a lot of them are very interesting investment opportunities. Demographic, again, the retirement of baby boomers, the millennium generation, that's now the largest generation out there, that if you understand the demographic trends, there are investment opportunities definitely associated with that. Some of the Hispanic and generally immigration population growth, that is also a lot of interesting potential investment opportunities, and regulatory as well. So anything from infrastructure that we already mentioned to healthcare, to regulation of banks, regulation of other industries, changes every time there is a new bill, like a big infrastructure bill that happened recently. That creates potential investment opportunities. These are all themes. So just to finish up on themes, the keys are to have an investment thesis. I'm not going to spend too much time on this, but basically you need to understand why this could potentially be an investment, because a social trend that may be coming and going may not necessarily be a good investment. So you need to have that. You need to have some idea of where the trend is going and what kind of growth it could achieve and the timelines. And sometimes it's hard to predict early on, but at least you need to know whether this is seasonal or just based on a one-time fact, or whether this could potentially go on for decades, like a major social secular trend or major technological shift. And then identify team beneficiaries, obviously easier said than done. This is usually better left to professionals, and even they get it wrong a lot of the times. But that's key, and a bigger key even is to identify pure plays. These are the potential companies usually or investment opportunities that are as close as to be all about the theme that you're looking for. Just to explain this a little bit is that if you look at something like artificial intelligence, the biggest players in that are companies like Google and Facebook and Microsoft and IBM, and those are not pure plays. Unfortunately, those are the companies that have a lot of other technology, but they also do artificial intelligence. And so while they belong in your portfolio, the ones that will drive the most potential results, the ones that are going to be correlated to the theme, are the companies, the smaller companies potentially that just focus on artificial intelligence. So identifying those are keys, are another big key to success in thematic investing. And of course, get in early. Again, easier said than done. There's more risk, but also there's a lot more opportunity. And that's not just on technology, it's on, again, any theme, whether it's geopolitics, which we'll talk about a little bit, or regulatory, or social trend, and so forth. Okay, so let's go back now to ESG and ESG data. So ESG, obviously, as it stands for environmental, social, and and governance. Within those three, there's a number of different things, and you saw the graph before from US SIF that has some of the major things that investors look at. The reality is there's a number of different companies that collect this data now. Some of the companies are starting to report some of this data, but these data fall into as many as I've seen over 200 different categories. And these are just some of the bigger ones, that a little bit more expanded than what you've seen on the graph, but a lot of different categories where The data is coming in from the companies or from research companies that are researching the companies. And then typically what you have from that data is that you compile scores. So you basically scale it because it depends on the type of data that you're getting. You need to know where it falls. So for example, on just the environment, so carbon intensity, which is one of the top things that everybody's talking about. If you know how much a particular company is emitting in carbon emissions, that number by itself may not tell you enough or not the full story. You need to be able to compare it to other companies. And so this is the idea of ESG score. Every major category will end up being scaled, and this will give you an approximate value compared to other companies within the industry and overall. So this is some of the data that you're looking at. And of course, then the idea would be for an ESG portfolio construction is that you would look at some of these high ESG sustainability scores on the right and strong investment potential without looking at the ESG scores on the left, and then a little Venn diagram to intersect them. And this is the green portion in the middle is your sweet spot, at least in theory. And if you look at, this is another survey done by TD Ameritrade not that long ago that asks ESG investors what are some of the most important factors to them, and you can see all of these different things, including social impact and the goals of the companies. But again, the rate of return is still maybe slightly, but it's still higher. So you can see these are all the top factors. And these are just some of the ESG data providers. You may recognize some of these names. Some of them are niche players. Some of them are very big companies like Morningstar and MSCI and Bloomberg. But the point is, there's a ton of these companies now consuming the data, providing the data, consuming the raw data, providing the analytical data to anybody who wants to consume it as investors or asset managers. And here lies the problem. If we're talking about something like financial data, that's highly standardized, it's very much regulated, and there is no two ways about it. If you need to find how much a company earned last year, you can, and it's one number. If you're talking about the ESG score, not so much. In fact, these are some of the ESG data issues, and as you can see, here's the correlation, for example, in credit ratings and ESG ratings between two leading data providers. Credit ratings, the correlation is 90%. Chances are, if you're looking at credit ratings, both top providers, you get roughly the same data. With ESG ratings, not necessarily. And these are some of the other issues. The categories are not always the same and not always mean the same things, even if they are called the same, because the methodology could be different. The data may be missing or unavailable. You could have all these multiple data providers. There is no standard access to data. If you're an individual investor, for the most part, you're not able to find a free access to all this data. So companies like the ones on the previous page pay for the data, for the raw data, and collect the scores and then sell that to money managers. So it becomes a little bit hard to get the data. And of course, there's also no reliable audit like you would have in the financial data, where auditors have to be by law checking the books every quarter. And there's also no standard scoring system or methodology. Everybody uses their own, and even though a lot of them may be similar, but they're not always the same. And of course, as I mentioned, no regulatory requirements, at least not yet. Europe is actually ahead of us, and in that sense, there's some regulatory framework, but it's still far from what we have, let's say, in financial reporting. And of course, there is this ugly new term, greenwashing. as this type of investing has become more and more popular, there's more and more stuff out there that looks like what you want, but not necessarily is. And because of all these issues that I mentioned before, it's for a common investor, it's very difficult to say. So these are just some of the things. I'm not going to go through all of them, but these are just some of the things that you may see out there that may not necessarily be what you're looking for. So, keep that in mind. And this basically ranges from, fluffy language that is trying to sound like this is what you want, but is not necessarily it. And it goes to outright lies, which have, some companies have already been fined for that. So one other thing I wanted to mention before we move on to the main portion of the program is the ESG shareholder activism. So activist shareholder is basically somebody who takes a stake in the company, who wants to change the company from within, and put a pressure on the board or management to actually make the change. And over the last couple of years, we've seen a lot more specifically ESG type of activism, not just changing the way that companies do business for financial results, but specifically for the good of the environment, or to have more social benefits, or to have a better governance structure. And some of the recent examples were specifically in fossil fuel industry. Last year, a little company called Engine Number One that took two board seats on ExxonMobil with less than, I believe, 0.01% of share ownership, which is quite remarkable. And there are other examples as well. One last thing, impact investing is not just for equities, even though this is what most people focus on, but you should also know that in addition to public equities, which we just touched on different things in there, there's fixed income, there's green bonds. I'm not going to go into that. That's a whole separate conversation, but basically it's bonds issued specifically for projects where they collect the funds that are earmarked for environmentally friendly projects. They've become extremely popular in the last few years. Of course, there are real assets as well. There are alternative assets, and there is also private equity. Basically, just like public equities, you could easily have private companies that will follow the same ideas. So I bet it all sounds pretty good so far. So why should we worry about values and conflicts? If we're following ESG, a specific theme, and we're looking at, let's say, green energy, what could possibly go wrong, right? And this is one of these subjects that is usually not coming up very often, definitely not from asset managers, and very few advisors typically venture out to talk to their clients about this. So let me just show you a few examples of what I'm talking about, and hopefully it will become pretty obvious. So let's just do this little exercise. British Petroleum. For most ESG investors, that would be a quick no. I mean, if you remember, well, first of all, it's a fossil fuel, obviously, but also a little over a decade ago, they had a major oil spill in the Mexican Gulf, was horrible for the environment, created a huge uproar. And so, like I said, this would be an easy example from most people, but think of it this way. The company is aggressively developing renewable energy sources. In fact, of all the oil and gas majors, this is probably the most advanced one, at least one of them. They even changed their logo, although that potentially could be for PR purposes, but the logo is also looking very, very nice and green. Well, the question to an investor is that something that changes your mind? Is that something that at least would put a consideration in your mind for having that in your portfolio, even if your value says no fossil fuels, because they're one of the leaders of moving away from fossil fuels. Maybe not. Something for you to think about. Let's do a few more. Nuclear energy, maybe a little bit more involved. So nuclear energy, the pros is that it's obviously low carbon energy, and it's sustainable in the sense that you don't deplete the resource, but nuclear waste is obviously a big issue, and the probability of meltdown. Yeah, we all know that it's low and it's safe, but don't tell it to people from Chernobyl or Fukushima or from 3 Mile Island. Obviously, this could happen, and especially with the recent Russian shelling of a nuclear plant in Ukraine, that raises some uncomfortable questions. But on the other hand, in the fight of weeding off the sort of fossil fuels, nuclear energy is one of the subjects in conversation. The point is, you as the end point investor, as the actual person in charge of your money, you have to make a decision. How does that fit within your values? Let's do a few more. So wind power, you may wonder why it's even in this list. Well, obviously it's a renewable energy, it's one of the leading ones. So why is it even on this list? Well, what if I told you that wind power is a major cause of death in birds? Does that change your mind at all? It's true. It's unfortunate. How do you reconcile those? What's more important to you? Again, is that something that changes the equation at all? Does that mean you won't include it, or does that mean you will lower your investment percentage, your weight in this investment as you would otherwise? That's something for an investor to decide. Cobalt miners, well, lithium as well, but cobalt specifically, obviously both of those are leading materials for batteries for electric vehicles and for many other electronics, I might add, but specifically for EVs. There's a problem specifically with cobalt. As it turns out, most of cobalt is mined in Africa, where most of the labor is child labor, and there are very poor labor conditions. Is that something that you care about? Is that something that enters your equation in terms of your personal values and how you invest into that? Would you invest in a company that mines cobalt for EVs if you find out it's 90% child labor in Africa? Something to think about. A few more. Facebook, sorry, the Meta platforms. I'm still getting used to the name. So obviously, this is a social networking. It has a VR technology, which is trying to rebrand as metaverse and everything with it. But on the cons, if you remember, just a couple of years ago, they had a major scandals on privacy controls. Where a lot of privacy has been taken over by a third party contractors and used for various things, including potentially influencing election results. And the way that they handled it was not the best, to say the least. So these are both the S and the G in the ESG. Does that change your mind? Interestingly enough, those 2 years ago, 2.5 years ago, several ESG funds actually dropped Facebook from their portfolios just because of that, but many others left it. Again, this is exactly the type of conflict where an investor has to make a decision what's more important and how to handle this. Bitcoin, another one that's been a lot in the press lately. So the decentralized finance, the idea of cryptocurrency has a lot of appeal, but at the same time, major energy usage. One of the statistics was that if Bitcoin miners was a separate country, in 2021, they would be number 20 overall in the list of energy usage, more so than an entire country of Argentina, for example. So not very green at all. And a lot of people have made comments on that. Again, is that what's more important? How do you reconcile those conflicts? That's something up to you to decide. Okay, anecdotally, this is another interesting one. Obviously, IBM is a large technology company, has been around for a long time, has done a lot of technology and automation, is one of the leaders in blockchain, in software as a service. From another advisor, I heard a story where an elderly Jewish gentleman came to him and said, "I don't care where you invest my money, just not in IBM." Why? Right? Well, believe it or not, in late 1930s, IBM had a contract with Nazi Germany and was working on them for a number of technology projects. Once the World War II started in 1939, they canceled the contract. And to be sure, obviously, this was many, many years ago. Nobody from that time is around at IBM, and obviously the world has moved on, but it's clearly an issue for at least one investor that I know, and it could be for others. Is that something that even enters the equation? Is that something that anybody should be considering at this point? That's again up to an investor to decide. And if you have that, just like that person, let your advisor know. Or if you're searching for a fund, try to look for it there. So I'll finish with the examples on that one. Again, something for people to consider, to think about. And now moving on to the values conflicts in ESG as far as the Russian invasion of Ukraine is considered. So little disclaimer here, I was actually born in Ukraine, even though I haven't been back in 30 years, and I don't consider myself Ukrainian, I consider myself an American, but it's definitely close to my heart, and I have a personal opinion about this. But as a rule of thumb, I try to leave politics away from investment decisions, try to leave emotions out of investment decisions. So we're going to look at this through the ESG investing prism only, and hopefully you can follow what I'm saying. So defensive weapons. This seems like a couple of months ago this would not be even a discussion. I have a number of clients who are against weapons of basically any kind, but now the question is. They may be little weapons for sure, but if they're used to fight invaders committing war crimes, does that change your view on this? Because now this is the S and G of that equation is changing a little bit. So again, this is a personal decision. You as an investor have to make it. Furthermore, what about non-lethal defense? So these are companies that provide basically supply chain management during wars, or provide supplies to the armies or to the citizens of the country that is under attack. Provide also surveillance and information. Again, normally this would be part of defense industry, and therefore most ESG investors would say no. But if they provide largely humanitarian aid, is that still something that could be considered? for your portfolio. And obviously, from the economic point of view, as if the demand is up, this potentially could be an investment opportunity. On the flip side, Russian state-owned companies, well, without going into the specific companies, there could be some ESG benefits. Let's just assume that there may be. But if they are owned by the state and therefore some of their income is contributing to potentially committing war crimes, does that change your equation? Is that a hard no, or would you still potentially consider investing in them? I guess the asterisk next to this should say, right now you can't really invest into this at all. But if you could, would you? Public companies, they're not state-owned. Again, may have some ESG benefits, but are they contributing? And if they are, is that the same situation or somewhat different? How would you look at that? Here's another one. So wheat and corn, between Russia and Ukraine, the Russian sanctions and Ukraine inability to export those, there's a very acute shortage of those in the world, and especially in some parts of Africa and some parts of Asia. They're worried about real hunger and people starving to death. The one more or less obvious place that could increase production in those things is Brazil. Unfortunately, it would have to come at the expense of Amazon deforestation. Now that's a really hard one. You tell me, how would you feel about that trade-off? Is that something as an ESG investor? Which side would you choose? People dying from hunger, or Amazon deforestation and therefore more environmental issues? All right, I'm going to try to finish up with these. So another one is Palladium, which Russia, because of Russian sanctions, Palladium, where Russia is a 40% exporter of the world Palladium, that has to be replenished somewhere, because the main usage of Palladium today is in the catalytic converters in cars. So that's obviously being used to decrease the pollution that the cars create from internal combustion engines. So that's another tough one. How do we replace this? Because without it, we're going to have more environmental issues. And then, of course, the big sort of elephant in the room, oil and gas. With Russian sanctions, that produces higher cost of gas, food, travel, basically virtually everything. And I know a lot of people say they're okay for as long as it stops Russian invasion. But what if it persists for 6 months, a year, 5 years? The costs are higher on basically everything. So that as an ESG investor, that's another tough pill to swallow. And speaking of the energy transition, this is, by the way, to the point about oil and energy, the recent quote from Elon Musk, obviously the Tesla founder and CEO. This is the problem. So in the short term, these are all the potentially temporary replacements of Russian oil, and all of them are difficult to achieve. I'm not going to go into too much detail. We're running out of time. But nuclear energy is also being considered again in Europe. But it's our belief that the long-term transition to renewables is going to be sped up because of it. So in retrospect, that could potentially be a positive. So we're not going to be able to do all of this, but I wanted to do this exercise with climate change. So fighting climate change is one of the sort of main goals of ESG investors. And it's not quite clear what fighting climate change looks like in terms of investing. Would actually probably take people a little bit of time to, think about how would you express your desire to fight climate change through your investments. It's not quite as simple as many other things. So some of the things I would normally run a poll here, but since we don't have a lot of people, it probably does not make sense. But I would just ask things like environmental protection or waste management. Is that part of fighting climate change? What about obviously alternative energy, or rather renewable energy, I should say? How about carbon capture? Is that part of it? And it turns out that pretty much all of them have something to do with fighting climate change. But things like environmental protection is only partially within that sphere. And actually, the whole waste management is an established industry and does a lot of work also in recycling. And that's a way to get into it, but not a direct way. In terms of renewable energy, obviously it helps, but what actually fights the climate change is not just building a renewable energy, but rather converting from fossil fuels to renewable energy. And capture and storage of carbon dioxide, that's actually the most direct way to do this, but it's very difficult to invest into it. So let me just show you. This is a list of 23 different ETFs that I consider to be in the climate change arena. And I put a lot of information in here, although I realize a lot of it is hard to read. But here's a few interesting things about them. I included performance. So as of early April, performance over 1 year and performance over 3 months. And also an ESG score, which is the last column. This is an ESG score based on ETFDB. This is the, I believe, one of the largest sites that compiles scores for ETFs. And so you can see, comparatively speaking, what all of these things are. And so what these ETFs do, if you look at the top 8, all of these ETFs try to fight the climate change by investing in companies that are pledging to reduce their carbon emissions. So just think about that. They basically start out with the universe of, let's say, large cap companies, and then they keep the ones that have made a pledge to reduce it, not necessarily have done anything about it, and cut out the ones that haven't. And so if you look at it, if you look at all these companies, these are the top 3 holdings. You can see holding 1, 2, and 3. What you're investing in is Apple, Microsoft, and Amazon. These are your ESG funds fighting climate change. Probably not something you would expect, but this is, now that I've explained the methodology, you would probably understand why these companies are what they are. The next 2 are using similar methodology, but it's for international companies. So again, you can see what they are. So Nestle is the largest holder, is the largest company that they're holding. The next group of 11 through 15, they're taking a slightly different approach. What they're looking for is something I just mentioned a couple of minutes ago. They're looking at companies that are trying again, making the promise of cutting their carbon emissions, but these are the worst offenders, which means these are the energy companies and industrial companies and chemical companies, the ones that right now produce the most carbon dioxide, and so hopefully can make the most difference. That's the logic behind it. But if you are trying to buy an ETF that fights a climate change, and you find out that the companies in there are, industrials and miners and energy companies, you're probably not happy. So you should know that before you invest in them. And the next two, 16 and 17, are also similar, but again, they're similar logic that applies to foreign companies. 18 and 19 are probably the two that are most different. They're trying to look at different ways of fighting climate change. One of them is dealing with specifically ocean companies, companies that are cleaning the oceans. And the last one is a vegan climate. So basically investing in companies that cut down on many livestock investing, which is where methane comes from. That also contributes to climate change and increased temperatures. And finally, the last four are investing directly in something called carbon allowance futures, which is the idea of a market where companies that produce too much carbon emissions have to pay for them. And there are various international laws that are trying to govern this, but it's only Europe and US at this point, and it's still not fully enforced. Some of these ETFs have been up quite a bit last year because of the COP26 conference in Glasgow, but they're down a lot this year. The problem with those is you're not investing in any companies per se. You're investing in this derivative that is very hard to track and very non-transparent. So that's potentially also an issue. So just to finish up with this subject, the idea of investing directly in capturing carbon and storing it, that's great. And this is one of the largest, what I would call pure plays, as I explained before. The company that just raised $650 million in private market for their technology. Unfortunately, it's a private company. Most people would not be able to invest into that, especially since they're not based in the US. This is a Swiss company. But even the US and Canadian startups, it's difficult for individuals to invest into it. So when we've tried to build a portfolio for carbon capture and storage, the problem is that very few of them are pure plays, and those are smaller companies, and they fill into the renewables. The companies that are actually leading this effort are companies that are chemicals, utilities, industrials, and but by far the largest sector is traditional oil and gas. In fact, the biggest leader in fighting climate change by capturing carbon, the company that made the most advance in terms of technology is ExxonMobil. And the second one is Chevron. So imagine having a portfolio to fight the climate change that has the two largest holdings in ExxonMobil and Chevron. We've had some interesting conversations with clients about this. This is, as far as personal values conflicts go, this is probably the biggest one that I can think of right now. But there are so many others that we haven't even touched on. ESG investing is about compromise. It's about understanding what your values are, first of all, and what are you investing in, whether or not those investments actually reflect the values that you are trying to share with your investments. So now very briefly, the second case study. This is ESG ETF. This is the largest ESG label ETF in the world today. It has over 25 billion under management today. The full name is iShares, which is BlackRock, and it's called ESG Aware MSCI USA ETF. And this is their stated objective. US companies that have positive environmental, social, and governance characteristics. So clearly states that it's ESG, but doesn't really go into a lot of details on this. So let's look under the hood. The prospectus says that what they're excluding from their ETF is all of these things: thermal coal, oil sands, tobacco, controversial weapons, nuclear weapons, thank God, and civilian firearms. Sounds good so far? Well, that also means that what's not excluded, as in included, is other fossil fuels. So anything other than oil sands and thermal coal is in it. Other things that typically a lot of ESG investors would exclude, the so-called sin industries, like alcohol, gambling, and potentially other things, they're all in there for sure. So the question becomes, is that really what an ESG investor expects when they invest into an ETF? The problem is, obviously, an individual investor is not likely to look in the prospectus, at least not for every investment. And when the company says they're ESG aware, what they're really talking about is that, yes, they use some ESG scores. They specifically exclude some things they don't want in it. And they use ESG scores as a factor. In other words, as another weight in their strategy on how to build their portfolio. So perhaps some fossil fuels may have a slightly lower ESG factor and therefore have a smaller weight, but it's definitely in your portfolio. It's up to you as an investor to decide, does that reflect your values? Is that what you're really looking for? Because this is not really greenwashing. I want to make sure this is understandable. iShares and BlackRock, they're not lying about it. It's right there in the prospectus. They're not trying to necessarily sugarcoat it, but the ESG aware label is a little misleading, possibly. However, everything is spelled out. You can see their portfolio. You can see on their prospectus what's excluded or included. It's up to the investor to decide whether this is what you actually want. And we've had clients who basically said, we don't need ESG investment expertise. We can just buy, an ETF like this. And, then they find out that ExxonMobil is in it, and so is all the rest, basically, of the fossil fuels, and they're shocked. Don't be shocked. Do your homework. Find out beforehand. And if you have an advisor, then you ask your advisor. So I know we're a little over time. I am basically going to try to finish up, and I'm gonna. This is the conclusion that I've been promising. This is where impact investing fits. This is sort of your line. All the way to the right, you have mainstream investing. This is where you only care about the result, your returns, your profit, no consideration for anything else. Then you have thematic investing, which has a consideration for certain themes. Some of them could fall under impact investing, not necessarily all of them. You could also have activism themes in here. That's thematic. Then it goes to socially responsible, where you're actually trying to actively strip out things you don't want in it. And then sustainable or ESG investing, where you actually only put stuff in there that you want. And then all the way to the left, you have philanthropy. This is basically the other side of it, where there's no financial consideration, only the idea of doing good. And this is your quick checklist. decide on what your values are and which one of those you want to actually express as in your investments, and how much of that you want to use to include or exclude or put importance on within your portfolio. And then once you have that, prioritize it with any other investment criteria that you may have, and then verify. Make sure that whatever you're thinking of investing in, whether it's a fund or you're working with an advisor, or an individual company, that your criteria fits within that investment. And just a couple of things about us. So as I mentioned, or that is Julia mentioned, I am the CEO and CIO of Eureka Wealth Solutions. We are a registered investment advisor located in New York. We're a fiduciary, which means client always comes first. And that's not a saying. This is an actual obligation. We're also hybrid, which means we can provide traditional full service investment management and financial planning, but we can do all digital only, similar to robo-advisors, for example. And we always start with your values and passions. So we ask all these questions up front about what would you like to see in your portfolio, what you don't like to see in your portfolio. In case it's still not obvious, we specialize in thematic and impact investing, and we actually have this large number, over 450 themes that we're following, that we have active portfolios available for. Over half of them fall within impact and ESG. And if we don't have something like that, we can usually build one for you, and they range of all kinds of things in terms of themes. One other thing that we do that I think sets us apart from just about any other wealth management company I've seen is that 2% of the fees you pay us, we actually donate to the charity of your choice, or rather it's choice of both us. We pre-vet some of the companies, some of the charities, I should say, and allow an investor to choose where some of their fees will go to. And we also provide all the other services, if this is a full service company. So again, just a quick introduction on who we are. We are also proud to be an associate partner of New York City Football Club for this season, the MLS champions. So if you're in New York, we're proud to be here. Just a quick show of how the portfolio allocation process works. You can also find it on our website. And there's an offer for joining us today, or for anybody who's actually going to watch this here. You can follow this link and put the promo code in there, and this will let us let you try us free for 30 days. Again, I don't believe this is daily done in our industry, because a lot of work goes up front to get to know the client, to build a portfolio for them. But we're so sure that you will see the difference, that we're letting you try us free for 30 days. And if you're not happy in 30 days, no strings attached, no questions asked, you're free to go, and you haven't paid us anything. So feel free to check us out. And just a couple of things about me. So I've been the CEO, co-founder since 2014. Generally have over 25 years of financial services experience, all across Wall Street, some of the largest banks, which is also one of the reasons I'm no longer there. A whole different story. And with that, I know we're over time. I try to cover quite a few things. This is the disclaimer that we've talked about before. Anybody who has any questions, this would be the time. Oh, I guess the only person we have now is Frank. Thank you, Frank, for joining. So if there are no other questions, All right. So again, this has been recorded. We'll leave the recording on for the time being. Just following the same link will get you there. Any questions, you can definitely email me. This is my email again here. Igor.zuckerman@eurekavaultsolutions.com. Feel free to email me directly. And I hope you enjoyed the webinar today. Any follow-up, feel free. Thank you very much. Julia, thank you for hosting as well. And hopefully we'll see you next time.